The S&P 500 has had a rocky start to 2025, down over 20% at its lowest point. Everything from Trump tariffs to increased inflation fears and geopolitical tensions are headwinds. But for long-term investors, often turbulence means opportunity. Welcome to Investing Edge with Eric. In today's video, I'm breaking down my latest portfolio moves, buying more of what I believe are some of the best businesses in the world. But why these specific stocks? Well, I'll walk you through what makes these companies really stand out. I'll give you my fair value estimates and the expected annual returns I have for each stock. We'll go through 4 key sections, starting with each of the 3 stocks that I've bought, from the least to the most undervalued, and then wrapping up with a portfolio update and a allocation breakdown, essentially. So yeah, let's dive into the first stock I've bought recently. So the first company I've started to buy more of is Microsoft stock. Now you might roll your eyes and say, well, everyone already owns Microsoft. Well, I'll give an explanation to why I think Microsoft is the best of the mega cap technology stocks in the US, and I'll also give you an overview to what the company does and my fair value estimates as well. So Microsoft is today worth roughly $3 trillion US, and that's actually more than the entire German stock market. How is it possible that one company can reach this type of scale? Well, part of it has to do with the incredibly diversified business that Microsoft runs. As part of the original big tech titans, Microsoft have built a very diversified business. It's essentially within 3 key areas. It's productivity and business processes, that's Microsoft Office, LinkedIn, etc. We also have intelligent cloud, that's Azure. It's rapidly growing cloud platform, which is of course competing with AWS from Amazon. And then there is more personal computing, where we have, for instance, Windows, Surface, we have Xbox if you're a gamer, and we have Bing for search, essentially. Now, most of its revenue comes from enterprise software and cloud services, with Azure growing at double-digit rates, neck and neck with AWS. That's why it's so important whenever Microsoft releases a quarterly report. Usually investors look at the Azure numbers first, right? Because that's the biggest and that's the most, the fastest growing part of Microsoft today. With sticky subscriptions, massive moats, and aggressive AI integration, Microsoft is a true compounder. But at today's prices, is it already priced for perfection? Before jumping into my model, here is just for reference how I usually analyze stocks. So I get 2 outputs. It's the estimated annual return, or the IRR. For that, I use 2 price targets. It's the enterprise value price target, and it's the free cash flow to equity price target. I also get a fair share price of the stock, and for that I use a discounted cash flow analysis. Right, so here we are at the model. Here you can see a essentially summary of my valuation of Microsoft stock. We won't go through the nitty and gritty details. That's usually for a specific valuation video, which I'll do at a later stage for Microsoft. What we can essentially see here is the projected free cash flow that we as investors might get if we buy the stock today. So here we have 2025 all the way up to 2034, and then we get a string of cash flows per share. Of course, we have to buy the stock today at the current share price, and we have to sell it at the future price target, and then we get a cash on cash return of roughly 2.5 times all the way up to 2034. Now, with that said, it gives us an estimate of where the stock should be valued today. I have given Microsoft a fair share price of 475 roughly US dollars. That's a discount of 22% versus its fair share price if we compare it to the current price that you can buy the stock today. Now, with that said, we could expect an IRR, that is the annual expected compounded return that we as investors might get from Microsoft stock, at roughly 12% per year. Now, that might not be breathtakingly amazing, but at least it's higher than what the market usually returns. I'm comparing Microsoft to the S&P 500, which usually provides, I would say, 9 to 10% per year. As Microsoft focuses more on software and not on, physical goods, as for instance Apple does, they are in many cases much more isolated from tariffs, from trade wars, than other companies that of course sell physical goods. At the same time, Microsoft is growing stronger than Apple and has a lower relative valuation than Apple at the same time, which makes it a no-brainer choice, at least over Apple, which is its most comparable large cap mega stock. But even with Microsoft, a seemingly perfect company on the surface, there are some risks. For instance, if Azure slows down, or if the investments into OpenAI and into AI in general don't materialize in time. Also, what makes Microsoft quite attractive is looking at their stock chart. Now, I'm not talking about their previous returns, but looking at how the company trades. It's a stock that has historically provided good returns without excess volatility. It's not a stock that is too unpredictable, too volatile for investors where you're constantly into 30, 40, 50% drawdowns. It's a stock that's quite consistent in terms of how it trades and how it compounds its returns for investors. Right, with that said, let's move on to the second company I've bought more shares of in recent days, and here it might become a bit more interesting. Now, the second company I bought more shares of is Take-Two Interactive. They own three powerhouse gaming studios, being Rockstar, 2K, and Zynga, behind franchises like NBA 2K, Red Dead Redemption, and of course, the famous Grand Theft Auto franchise. And that's the focus here, Grand Theft Auto or GTA. GTA is one of the most iconic gaming franchises ever. The last title, GTA 5, came out back in 2013, and gamers around the world are waiting over a decade for the next installment. With GTA 6 expected in 2025, Take-Two stock has already jumped around 50% in anticipation. But how can one game move the needle so much? Well, in essence, it's because this isn't just any other release. It could be a billion-dollar launch within days, kicking off a new super cycle for the company for many years to come. Now, beyond blockbuster titles, Take-Two now earns a growing chunk of its revenues from in-game spending. Here I'm referring to microtransactions, virtual currencies, and DLC content as well. All high-margin, recurring revenue streams for Take-Two for many years to come. With that said, still, long development cycles and execution risk still remains for the company. If GTA 6 for whatever reason flops as a game, then there really isn't anything else in the other studios that Take-Two owns that could make up for the lack of performance from GTA. Now, with that said, I would still say that the company is undervalued. I've made already a detailed video on Take-Two Interactive, so please go back to my channel if you'd like to look at that. But here we have a summary essentially of the full valuation model. Now, with that said, looking at the cash flows that we as investors might get, of course, we have to buy the stock, we have to sell the stock at our target price. This implies a cash-on-cash return of 2.7 times all the way up to 2034. Now, this is also a discount versus its current share price of 38%, which I find quite attractive, and the IRR of 12% per year. Also to add is that the assumptions behind this analysis assumes that GTA 6 will become the same level of success that GTA 5 was for Take-Two Interactive. Now that's a big if, right? There's still risk that GTA 6 flops, but if you, like me, expects that the game will be a slam dunk hit, right, of a game that players will play for, 10, 15, 20 years ahead in time, then I would say yes, this stock is most likely undervalued today. So we've now gone through 2 out of the 3 stocks that I've bought recently or added to my portfolio. Let's go through the third stock, which I think could be the most undervalued of the 3. So the third stock that I've started to buy more shares of is called S&P Global. It's the most undervalued of the 3 stocks I've presented here today. It could be because it's the most boring company of the 3, I don't know. But let's start with a brief overview. What is it that S&P Global actually does as a company? Every time a company issues a bond or gets a credit rating, there's a good chance that S&P Global gets paid. This low-profile company priced over 70% of global debt in 2023. So how does a behind-the-scenes data firm dominate trillion-dollar markets? Founded in 1860, S&P Global is now a leader in financial intelligence, operating in a tight oligopoly with Moody's and Fitch, holding the largest market share in the world at roughly 40%. Now, with that massive market share, S&P Global essentially operates in a few key segments. One of them being ratings, which is credit ratings for companies and governments. We also have market intelligence, which is financial data analytics and research. And we also have the most famous one, I suppose, the S&P Dow Jones indices, which include the licensing for the S&P 500 index. And then we have commodity insights, which includes energy and resource data, essentially. And on this slide, you can see a few really important things. First of all, that all of these segments are growing. It's growing quite well. I would say on average, it's 10% for the company as a whole. And look at the adjusted operating margin. We have 33, 58, 46, 38, 69% for S&P Dow Jones indices, averaging out at roughly 47% for the whole company, which is absolutely massive margins. So what's S&P Global's edge? Well, it has deep network effects, it has sticky clients, and critical infrastructure in capital markets. So what's the catch then? It can't be all perfect, right? Well, I would say that S&P Global is of course heavily exposed to debt issuance, which makes the company somewhat cyclical. If the economy is not expanding and issuing more debt, then of course that might affect S&P Global and their revenues and profitability. Now, with that said, here comes the interesting part. Looking at the summary of my valuation, I can see that I've got a fair share price of $710 for S&P Global, and that's quite a massive discount, right? It's a discount of 53% versus its current share price. Now, also looking at the summary, we can see that I got a 14% IRR. That's the annual compounded return that we can expect from S&P Global all the way up until 2034. Now, what makes this investment so amazing, in my opinion, is yes, we have an undervalued stock, but we also have a fantastic business model where S&P Global absolutely dominates the market. And that dominance, of course, reduces risk for us as investors, and it also does another great thing. It makes it much more predictable to model and to analyze and understand this company versus other companies that are not as predictable or well insulated against tariffs, other macro and legal risks out there. So now I've gone through 3 stocks that I've added more shares to in my portfolio. Let's round up with just a brief portfolio update to showcase how much I've allocated my total assets to these 3 stocks. So yeah, here we go. Starting off with Microsoft, it's currently a 7.2% weighting in my portfolio. We have Take-Two Interactive at 4.7%, and then we have S&P Global at 4%. Now, to conclude, I usually don't go above 7% for any individual stock. In the case of Microsoft, as you can see, that's at the very upper limit. But in the case of S&P Global and Take-Two Interactive, I might add even more shares if the market continues to sell off in the coming weeks or months. And just to note that these are not the top 3 stock holdings in my portfolio, but as a total, the 3 represent roughly 16% of my portfolio as of today. So yeah, thank you so much for watching this video. If you have any questions, please write them below. I'll get back to you as soon as possible. And yeah, please like and subscribe. I'll see you in the next one.